Imagine this. You work for years building your startup from nothing. Late nights, sacrifices. You finally get your exit, the big payday. But then the tax bill arrives. For most founders, capital gains taxes can turn that victory into a financial nightmare. But what if I told you there's a secret weapon hidden in the US tax code? A way to turn millions from your sale into tax-free money? It's called QSBS. And today, you'll learn exactly how it works and how to use it. QSBS stands for Qualified Small Business Stock. It's a tax provision created by the IRS through Section 1202. Here's the deal. It allows you to exclude a portion, or even 100%, of the capital gains you make when selling your company's stock. The benefit is massive. We're talking about exclusions starting at $10 million, going up to $15 million per taxpayer, or 10 times your cost basis, whichever is greater. For many founders, this means the entire sale can be completely free of federal taxes. But patience is required. You must hold the stock for a certain period. For stock issued after July 4th, 2025, the rules are even better. 50% exclusion after 3 years, 75% after 4 years, and 100% after 5 years. But not every startup qualifies. There are 3 essential conditions. Number 1, is your company a C Corp? The stock must be issued by a company taxed as a C Corp, not an S Corp, not an LLC. This is one of the main reasons most tech startups choose the C Corp structure. Number 2, did you receive the stock at original issuance? You must have received the stock directly from the company when it was issued, not purchased it on the secondary market. Number 3, are the company's gross assets under $75 million? The company must not have had gross assets exceeding $75 million at the time of issuance and immediately after. And here's the key. We're talking about cash in the bank, not valuation. A company valued at $1 billion can still qualify as long as its gross assets are under this threshold. Okay, your company qualifies. How do you maximize the tax benefit? This is where advanced strategies come in. Let's start with stacking. QSBS applies on a per-taxpayer basis. This means if you give some of your qualified stock to family members or trusts, each of them can use their own exclusion. For example, you can transfer shares into a non-grantor trust for your children. This trust is considered a separate taxpayer, so it gets its own $15 million exclusion limit. 3 children means 3 additional exclusions. That's $45 million tax-free instead of $15 million. But be careful. Transfers must be made well before a sale becomes certain. If you gift shares after signing a letter of intent, the IRS can invoke the assignment of income doctrine and attribute the entire gain to you. Now let's talk about packing. Most founders have a zero cost basis in their stock because they didn't invest money at the beginning. But what if you could change that? The packing strategy involves contributing assets, like intellectual property, into an LLC, and then converting that LLC into a C Corp. Your cost basis becomes the fair market value of those contributed assets. Then, when you sell, that cost basis, multiplied by 10 under QSBS rules, can cover much more tax-free money. Let's say you contribute IP valued at $500,000. Now your cost basis is $500,000, not zero. That becomes $5 million of tax-free proceeds under the 10 times basis rule. QSBS is incredibly powerful, but you can lose the benefit through simple mistakes. Mistake number 1, losing qualification. If your company's gross assets exceed the $75 million threshold before a new stock issuance, you'll lose qualification for those new shares. Once lost, qualification cannot be recovered, even if assets drop later. Mistake number 2, lack of documentation. The case of Jew versus United States is a critical warning. A taxpayer couldn't prove his shares were QSBS because he didn't have the original stock certificate or the financial documents from the time of issuance. The IRS rejected his exclusion request. If you don't have the papers proving qualification, it doesn't exist in the eyes of the law. Your checklist should include original stock certificate, company financial statements from the issuance date, and contemporaneous records. QSBS isn't just a tax provision. It's a reward for taking the risk of building an innovative business. It can mean the difference between a good exit and a life-changing one. If you're a founder, your first step is to talk to your corporate attorney and a specialized tax advisor. Ask them, are we qualified for QSBS? What can we do now to maximize the benefit when we sell? This benefit isn't a secret, but it's often overlooked. Now you know the secret. Use it wisely. Subscribe for more strategies like this. And comment below. What's your biggest tax question?